Good evening, everyone. Today we'll be dealing with the accounting standard called IAS 16. That accounting standard deals with property, plant, and equipment. And what is property, plant, and equipment? It is a tangible item, right, used for the production or supply of goods and services or service for rental to others or for administrative purposes, expected to be used for more than one period. I will use this example to show some critical principles of property, plant, and equipment. So within property, plant, and equipment, we need to learn how to recognize and measure the asset at initial acquisition. Secondly, we need to be able to know how to measure it subsequent to acquisition. And finally, we need to be able to disclose property, plant, and equipment. So we will use an example to highlight some of these principles. And secondly, we'll use this example to show some hidden mathematical principles that are often there in the questions that we ask, and that needs a little bit of critical thinking. So the question that I'll be dealing with is called Basop Manufacturing Limited. That is the name of the company. The background is that you are the auditor of Basop Manufacturing Limited, and you are given this information. So the information relates to property, plant, and equipment for the year ended 31st December 20X5. So you are given the carrying amounts, the equipment at carrying amount, the furniture at carrying amount, vehicles at carrying amount, land, building at carrying amount. But now you want to ask the question, what is the carrying amount? And the carrying amount is effectively your cost, which is your initial cost that you recognized this asset at, minus your depreciation and your impairment. And I want to unpack a little bit of what do I mean by initial cost. And initial cost is the purchase price that you use to purchase an asset plus directly attributable costs. And as we deal with this transaction, I will be explaining what is a directly attributable cost. And also it is future expected costs, and we'll explain that. But we start with these initial costs. So if we look at our property, plant, and equipment, we see that we are given furniture, vehicles, and buildings. And what is unique about all these assets is that they are tangible. You can touch them. And next to them, we are told in additional information that depreciation on property, plant, and equipment is provided as follows. Now the question is, what is depreciation then? So depreciation represents the usage. So the drop in value of that asset as a result of using it. It does not talk about drop in value created by things such as damages. That could be impairment. So depreciation is allocated using a form of a systematic allocation. For instance, we're told that equipment is depreciated at 15% on the straight line method, furniture at 20% on the straight line method. And part of this example that I'm giving you, it is to unpack this kind of reasoning that has implicit mathematical language in it. And then vehicle is 25% on diminishing balance method. And we're told that buildings is 5%. Now, if we go back, we gave you the carrying amounts, but we did not give you the carrying amount of land. But we gave you the carrying amount of others. It is because land does not get depreciated. Now we look at the transactions. We're told that all property, plant, and equipment was purchased and taken into account, into use on 1 January 20X3 unless indicated or implied. Now, here's another principle on IS 16, is that when do we start to recognize an asset that is PPE? It is when it is available for use. When the asset is available for use, we then can start from the day to depreciate it. So all property, plant, and equipment was taken into account on that 1st of January, unless indicated. And then we're told that on the 31st of March, the company disposed of furniture. So I've given you a picture on figure 1 of what is a typical furniture of a company. You see office desks, and you see they've got laptops, and then there's chairs there. That is the type of furniture typically in a company. So the company disposed of the furniture. And the furniture that they disposed of was 150,000. The accumulated depreciation at 31st December 2004 was 60,000. The proceeds on disposal were 100,000. The transaction has been correctly recorded in the accounting records. Why do I need to tell you all these details? It is because the carrying amount of the furniture that you see on the 31st December is 320,000. But which means that carrying amount excludes the furniture that was sold. So being disposed means that during the year, within 3 months of our financial year, we had furniture that had an original cost of 150,000 that had been sold. What that implies also is that part of the depreciation expense that had to be taken into account during the year includes the 3 months that relate to the furniture that was disposed. We also learned that during the year, the company built new equipment. Now, this new equipment, the components, they costed 50,000. The labor, it costed 20,000, and consulting engineers costed 15,000. And we're speaking about how do you measure an item of property, plant, and equipment? What is its initial measurement? And we said it's initially measured at cost. But then we said cost is not just the purchase price, but it includes something we call directly attributable costs. Looking at figure 2, you see a machine there being assembled. So I took a machine of a piggery machine, and you see consulting engineers as it's being constructed. And you see a laborer working with a consulting engineer. So you do not only take into account the purchase price of the components, but also this directly attributable cost, because you wouldn't have this machine unless there was these consulting engineers, unless there was the labor element. So all the directly attributable costs, they must be taken into account at initial cost. You have to take into account the components, the labor, and the consulting engineers in this example. So we're also told that included in the original cost of 1 million of the machine was the major inspections. So what are major inspections? Typically, there are items of property, plant, and equipment that are impossible to operate unless there's inspections. The best example could be an item such as an aircraft, where at intervals of, for an example, 2 years, you need to pay the amount for major inspections. As in this case of this equipment that was bought, there are major inspections that are performed. And major inspections, because they are depreciated differently, often they are separated in the disclosure note. But in this case, we know that the original cost included the major inspection. The company did not apply the component approach when the original purchase was recorded. The equipment underwent a second major inspection of 180,000, and this has not been recorded yet. The next major inspection will be done on 12 January 20X8. So the figure 3 that you see there illustrates a typical machine inspection, that you have an outside consultant, be it an engineer, who comes and do the inspection and be able to have a certified report that an inspection was performed on the machine. And then lastly, the transaction at the end talks about land and building. So land and building comprises of an office block located at 27 Seaview Road in East London, which costed 1.95 million on 1st January 20X3. What's important about this figure is that there is a different behavior on the building and land. As we explained, that land is not depreciated, while building is depreciated. So which means you first have to separate the cost of the land and from the building so that you can be able to depreciate the building. Now let's look at what is required for us to do in this question. It says, disclose a note on property, plant, and equipment to the statement of financial position of Basop Manufacturing Limited at 31st December 20X5. The note must be compliant with the minimum requirements of Companies Act and International Financial Reporting Standards. And it tells you what to ignore. It says ignore value-added tax, and the total column may be omitted.